The wrong answer is to increase the tax on investments. So if anyone is listening in from the current Labor government, get rid of your CGT reforms or radically change them.
Hello and welcome to the show. Australia is now in the better part of a decade of a productivity slump, and we've just had another quarter of the economy going backwards in per capita terms, per person. That's the backdrop to this episode. Rather than go through all the headlines, I want to talk about the thread, the connection between all of the news that we've heard around productivity, around living standards. I think one question connects much of what's going wrong. Are we doing the things that encourage investment in the economy, or are we doing things that discourage it? The four conversations that you'll hear this episode, they all come back to that question. And they're drawn from my latest live stream, from my other podcast with John Humphreys, Death and Taxes, the podcast of the Australian Taxpayers Alliance. In the latest live stream of that, we dealt with this big question. So in this episode, I'm going to begin with a clip that gets to the fundamentals of what drives productivity in the first place and why savings and investment and the culture that supports them matter so much more than any particular policy. From there, we're going to talk about capital gains tax. The Australian government has made some controversial changes, or it's proposing those changes. These were announced in the federal budget last month. And we talk about why there is an economic case to tax income from capital at a different rate to income from wages. This is a case that the government, in its proposed changes to the tax system, doesn't appear to understand. After that, we're going to talk about public investment and whether Brisbane's once-in-a-generation Olympics build, whether that will genuinely fix the infrastructure gaps we have, or will it just misallocate capital on a grand scale? Finally, we'll finish on the spending side of things with the National Disability Insurance Scheme. And we'll cover the idea that is so important in economics and an important insight and drives a lot of the propositions, a lot of the predictions of economics, that people respond to incentives, whether you design for that or not. So this episode, we're covering investment and incentives from start to finish. Before we get into the discussion, let me set the scene, partly because when John and I recorded this, a lot of it was us looking at and pointing at the charts on the screen, and you can't see those unless you're watching it on YouTube. So I'll put the numbers into words. In the March quarter, Australian GDP grew at 0.3%. So it sounds positive, but with the growth rate of population, what happens is that you're spreading the GDP across more people. GDP per capita actually went backwards by 0.1%. We should care about GDP per capita, because ultimately that's what underpins our living standards. That's a measure of our living standards. What the economy can produce per person. On the headline figure, the economy is growing, but on the per capita figure, we're flirting with possibly another per capita recession where we have 2 consecutive quarters or more of negative growth in per capita terms, and that's something we've talked about on the show before. 0.3% is it's a weak GDP result, and it's one of the reasons that the Reserve Bank won't lift interest rates at this next meeting in June. 0.3% in annualised terms is a bit over 1%, around 1.2%, and that's well below the types of growth rates for GDP that we would think of as reasonable, as we would think of as being close to the trend growth rate of, say, 3% or so, broadly speaking, at the moment. Possibly, and that will be trending down owing to slower population growth in the future, if we believe some of the IGR projections. In any case, it's a weak number that we had this recent quarter. And another point to note is that if you strip out the investment in data centers that's occurring because of the AI boom, that's a big part of the investment pickup that the Treasurer has been celebrating. If you take that out, then the picture is softer still. So to the extent we're getting growth, we've been reliant on this very significant investment in data centers. Now, that could well be a good thing. We probably do need them with the demands for AI, but just something to keep in mind. The other bit of data that we looked at was productivity, so GDP per hour worked. And what's striking there is if you chart that, then over the last decade, it's essentially flat. There was a spike during the COVID period, partly because, we had a lot of workers doing some of the lower paid jobs. They couldn't work due to social distancing, due to lockdowns, etc. So people working in cafes, doing delivery or food delivery jobs, etc. Well, because some of the foreign students had gone home, they were no longer in Australia. So what we had was a spike in productivity during that period. We had a loss of some of those less productive, fewer hours from less productive jobs, which meant this artificial, in a way, increase in productivity. But that's gone now, and essentially the story is we've had roughly stagnant productivity over the last decade or so. And what we have at the same time is an economy that's not experiencing any productivity growth. We've got strong population growth. Indeed, the week before we recorded this conversation, the population clock, actually it may have been the week we did record the conversation, might have been a few days ago actually, but it's very recent. The population tracker of the ABS. It's producing a real-time estimate of the Australian population. It ticked over 28 million people. And that raises all the familiar questions about whether Australia's housing, whether our infrastructure is keeping pace with the population growth. And these are the reasons why I've framed this episode around investment and incentives. Productivity, to improve productivity, we need investment. We need businesses investing in new capital, in new plant and equipment, in new buildings. We need businesses investing in R&D, transforming their processes. We need innovation. So the question that I'm going to keep coming back to, and it's a question that John and I keep coming back to, and it's across a lot of areas. The question is, are our policy settings encouraging the investment we need, or are they discouraging it? So keep that in mind, because this is a theme that goes through all four of the conversations that I'm featuring in this episode. So let's start with the most fundamental one. What are the core underpinnings of productivity in the first place?
Anna had this point for you earlier when we talked about productivity.
Yeah.
She said, Jean might ask the people of Belfast if productivity is the main driver of their living standards and not social homogeneity. I think she misunderstood your point. I think productivity is a problem, and so is social cohesion. It's not either or, but yeah, it's it is a worrying trend.
Yeah. Well, I think we could have another session, John, where we talk about, well, what are the drivers? I mean, what are the fundamentals behind productivity? And then we can get into, well, I mean, there's the whole Deirdre McCloskey argument about the bourgeois values that have enabled the Western European countries that enable them to thrive, that encourage savings and thrift and then capital accumulation and the hard work, that Protestant work ethic. I mean, there's that argument that's more fundamental. So we say productivity, and yeah, that's a very abstract concept, but underlying productivity is a whole bunch of behaviours that we just take for granted, I suppose, but we could unpack them in a future episode.
Well, we do it every time. I'm going to do it right now. That's the rant I normally do. You have to fix productivity. To fix it, the only solution is private investment and innovation. That basically, innovation comes from private investment itself anyway. So you need the private investment. That's to invest, you need savings. So you need to have that savings ethic, which is where those values, those Protestant, particularly Calvinist sort of values kick in, where the Calvinists save him when they don't have to, even when it makes no sense. But God bless them. There's probably good for our countries. And yeah, I think there's a lot of truth in that. I think we have unpacked that quite a bit, where we talk about if you don't get that saving and investment up, then you're not going to be able to solve it, which is why I've always argued, to get this in as well, that we should make savings tax deductible, or at least some amount of savings tax deductible, to incentivize that saving and investment domestically as well.
Okay, so the next conversation that I'll feature is about the proposed changes to capital gains tax in the most recent federal budget. That's the most consequential change in the budget. And I'd better set this up properly, because this clip assumes you'll already know what's being proposed. Under the current system, if you hold an asset for more than a year and sell it at a gain, you're taxed on only half of that gain. So there's a 50% capital gains tax discount, or CGT discount. The government wants to change that. it's going to replace the 50% discount with indexation, with an indexation method whereby effectively you'll only be taxed on the gain above inflation. So you won't be taxed on any part of the capital gain that is simply due to inflation. You'll be taxed on the real capital gain. And what it does is it indexes or inflates the value of the asset when you bought it, the purchase price of the asset, and it brings it into current prices by adjusting it for inflation. So applying the inflation rates that have occurred since then, it indexes it. Now, this is expected to increase the amount of tax that's paid on capital gains because the nominal rate of return on an asset is typically more than twice the rate of inflation. So in Australia, we have an inflation target whereby we expect the average rate of inflation to be 2.5%. But if you've got an asset and it's earning 6 or say 7%, then 7% less the 2.5, that's 4.5% gain that you'll be taxed on. Okay? Whereas that's it with the adjustment for inflation, but under the previous approach, it would be half of that 7% that you'd end up being taxed on when you sold the asset. And that's why it's expected that this new method will result in more capital gains tax being paid, and in fact, we'll probably have the highest rate of taxation on capital gains in the world. There are also changes to what's called negative gearing. So if you purchase from budget night, if you buy a property that's already established and it's not a new property, you'll no longer be able to use any losses you make on that rental property, say because of the interest expenses or depreciation, where if you make a loss on it, so the rental income doesn't cover the interest expenses, depreciation, maintenance, etc., those other expenses associated with having an investment property, then you can no longer use that to reduce your income from other sources. So labour income, you can no longer use that as a way to reduce your tax bill. You'll still be able to carry it forward and use it to reduce the tax you pay on your capital gains, but you won't be able to use it in the current year. Now, that's another unpopular change, and that it looks like that's having some significant impacts on the market already. So the negative gearing and the capital gains tax, these changes together are very much disincentivizing investment into established Australian property. The government's hoping that it will mean that investors will still be investing in new properties and that it'll encourage them to actually build new properties. But whether that occurs or not, we shall see. I mean, at the moment we're seeing potentially very adverse impacts on the housing market. This is something we still have to wait and see how all of this develops, and indeed whether these changes pass the Senate, whether they're ultimately approved by the Parliament. Lots of issues here, but just before I go into John's thoughts and my thoughts on capital gains tax. So we should go into what's the government trying to do here. It's, one, I mean, it looks like they're certainly raising, significant amounts of revenue from this, so billions of dollars, but they argue that this needs to be done from the point of view of fairness, of levelling the playing field, of taxing income from capital, similar to taxes from labour. They argued that previously it was unfair because if you earned $100,000, say, from wages, then you would pay more tax on that than if you earned that $100,000 from being a property investor, whether from from the capital gain. If you were one of these negatively geared investors who may not have necessarily been making profits on the rental property, but you were looking for that capital appreciation, that capital gain, and then you're making money off that capital gain, then you'd be paying a lower amount of tax than the person who made that $100,000 via wages, because the capital gain would be discounted by 50%. So you'd only be paying tax on $50,000 rather than $100,000. So that's the government's argument. There's a fairness argument. And the other argument they'll make is that the existing tax settings favoured property investors, and it meant that they could outcompete first home buyers for properties, and it was seen, these existing property investment settings were seen as disadvantaging first home buyers. And one of the rationales for what the government's proposing is to address that disadvantage. So they would be the major reasons behind what the government's doing. It was of the view that there was too much money being diverted, too much capital being diverted into established housing, and not enough into new housing, for example. And they're hoping that this policy change will divert that investment into new housing. Now, whether it does or not, we shall see. It's not actually improving or providing any additional incentive to invest in the new housing. It's simply taking away or reducing the incentive to invest elsewhere. So let's see ultimately what happens. I'm skeptical of what the government is proposing, but as always, we should maintain an open mind about these things. What I'm going to play now is John's thoughts on why this argument about taxing capital and labour at the same rate, what's the theoretical, what's the logical problem with this? And I think this is one area where the federal government is exposed. I think it's one area where they haven't done their homework, where they haven't fully thought it through. So let's have a listen to this conversation between John and me on whether it's logical or not logical to tax capital income and labour income the same. just while I remember regarding Richard Holden, he wrote an absolutely brilliant op-ed in the Fin Review a couple of weeks ago. I think it was while you were on training, about why the government's message around, well, we're going to be taxing capital income like labour income. And he was saying, well, that doesn't actually make any sense in economic theory because of the risk element associated with capital income. And there's good reasons from an economic point of view why you would tax capital income lower. I mean, for one, you're buying you're investing, or you're saving and investing out of after-tax income for one. Yes, you want lower taxes on capital to encourage entrepreneurship. So I thought that was a really excellent column. I don't know, did you see that, John? That column of
I
Richard
haven't.
Holden?
I must have been locked away in Kapuka at the
Yeah,
time. But look, I, the obvious economic point is that people just respond more to capital taxes as well. There's a higher
true.
elasticity, which means that
Yes.
unfortunately, I don't want this to be the case. I'm just observing it, observing reality. That the behavioral response to wage taxes is relatively low. It's not zero, as some weirdos claim, but it is relatively low compared to other elasticities out there. The elasticity to capital tax is much higher for the very obvious reason that most people need a job, but not everyone needs to forego current consumption. Make sacrifices now to save, to invest in a risky business. You don't. Not everyone has to do that, right? That's kind of discretionary. And also, just the simple point that if money is going to cost you 10%, if an investment's going to cost you, say, 10% return, you'll do it if you're making 20%. But if you're only making 9%, you just won't do it. There's a really easy cutoff, will or will not do next investment based on your expected return from that investment. And if you lower the return, you lower the investment. So that's the economic point. But I'd take a step back from that because I can understand the response. There's two arguments. One is treat all income equally.
Mm.
The other one is treat income depending on its behavioral response, right? Depending on the elasticity, right?
Yeah,
If you wanted to maximize economic efficiency, you'd do the latter. What that
yeah,
unfortunately means is you tax capital income less than labor income, and you can understand why people are annoyed by that, right? The equity issue, the seeming unfairness, because a lot of normal people just earn a wage. Why do they have to pay higher taxes? My complaint, I think you can sidestep that by just noting they're not even introducing equal taxes because they're not compensating for the time value of money.
yes,
And that's why I make that point, right? I'm not arguing to index it to like the PRRT has roughly the system I'm suggesting, but they index to inflation plus like 10 or 15 or 20%, right? They index very generously in the PRRT. If I was just trying to lower capital tax, I would be saying, yes, index it to inflation plus 10%. But I'm saying just to 2% to compensate for the time value of money. That's consistent with their argument. If they meant what they said, that they wanted consistency in the tax system, then that's their approach. And also, if they want consistency in the tax system, you can't take away the tax-free threshold on capital gains, and you should apply the same approach to interest income as well, which is another little bugbear that we treat all the different types of income differently. Right?
yes,
Wage income, interest income, dividend income, and capital gains are all taxed differently, which is
yeah,
absurd. And they are not proposing a system that is going to equalize the treatment. My system would be closer to doing that. So if they meant what they said, if they're genuine in their arguments, come and meet me.
Okay, so we've been talking so far about private sector investment. Government does a lot of investment too, and one set of or one category of public investment that's going to be very significant in my state of Queensland in the coming years is the big capital works program associated with the 2032 Brisbane Olympics. This is being seen as something that will provide a legacy that will catalyse additional infrastructure spending, that will catalyse improvements to the city, to southeast Queensland, indeed to the state, because there are some regional events. There's rowing in Rockhampton. There's equestrian events in Toowoomba, for example. Now, the question that John posed to me in our live stream, and which this clip covers, is to what extent does this Olympics infrastructure bill, does it help address the possibly what we had as a misallocation of capital already? I mean, it looks like we've had a situation where we haven't invested enough to keep up with population growth. We've had very strong population growth, and that's strained our infrastructure. Is the Olympics a way of catching up? Will we get the infrastructure out of that to address the bottlenecks, to address the growing population? Although that was an interesting question from John there. So this is a good example of John being the devil's advocate, as he often is, and he's wondering whether it could be the case that there's an overbuild from the Olympics that compensates for what may have been underinvestment previously. That's an interesting question. So let's hear the conversation.
Yes. Well, I mean, sorry, Lyndon's got another point here that I'd
Yeah.
love you to comment on. It's quite an interesting one here. I noticed Brisbane is doing, or at least was doing quite well up until a few months ago, as was Perth. Lyndon
Well,
suggests here is Brisbane doing well because of the Olympics?
yeah. I agree. I disagree that the Olympics build is cranking up. I suppose it is in a way. They've put the fences up at Victoria Park, and they've had to move on a lot of the protesters. So I suppose it's cranking up, but boy, we're really behind. I'm starting to worry just about our ability to deliver this in time and not end up in a Montreal situation where we don't have we've got the stadium not fully complete by the end, and you get into a situation where you're close to the deadline and the unions go, "Oh, gee, we've got the ability to really just really tighten the screws and get some, higher wages to make uh, to actually finish this project." So, yeah, I'm a bit concerned about that. But yeah, generally, Lyndon, I agree with you. I think a lot of it is the Olympics. It's excitement about Brisbane. It's also just, yeah, I mean, we've still got significant interstate migration. People want to live here and in Queensland versus New South Wales or Victoria. And I mean, why wouldn't
Well,
you
as they
really?
should, obviously. But I mean, with
Absolutely.
the impact of the Olympics, I would have thought it shows up in expectations, right? So you're buying
It
something if you think its
does.
value will hold up. You think its value will hold up because, the Olympics is a few years away. So it's gonna trickle down that way, even if you see no action on the ground. And I agree, I haven't seen too much, but
Well, it was a lot of
yes.
investor interest. So you saw that of the new lending that was the new loans that were being written, excluding refinancing in Queensland. I think we had about 40% being written for investors. So there's been a lot of investor interest, and I think a lot of interstate investor interest in Queensland because of the Olympics. Which, when you think about it, is that really sensible? Given that it's a couple of weeks, or maybe you got Paralympics too, but they don't get the same crowd, do they? Unless
Well, I think
I'm
the if I'm being generous, because I suspect it is just people getting a little bit carried away, but if I'm being
yeah,
generous with the potential rationale, what the Olympics often does is it creates an artificial boom in infrastructure spending,
yeah.
which often can be a misallocation of capital. But hear me out with the devil's advocate here. If we are already misallocating capital by underinvesting in infrastructure, could it be that the mistake created by the Olympics offsets the mistake made by our politicians underinvesting in infrastructure anyway? And that increase in infrastructure increases our capacity to be able to sustainably build livable housing and accommodate a growing population. I I'm being quite generous with my interpretation there, but it's a bit of devil's advocate. But that might be the rationale. The infrastructure boom that is needed might come because of the Olympics.
Potentially. The Gee, I mean, I still think they're going to struggle to fund the infrastructure that's necessary to support population growth because they're spending billions on this new Vic Park Stadium. We're going to get some lovely new sporting facilities out of it, but that doesn't necessarily address the infrastructure gaps that we have, does it? That's not where we need the spending. It doesn't alleviate the bottlenecks on Centenary Highway out to Ipswich. So I'm not sure that that's necessarily the infrastructure spending we need. That's what
No,
I
I
would
haven't looked
be.
into what they're actually planning on doing. You would have thought they'd take the opportunity to upgrade transport. You've got to get people to and from a lot of events very quickly in an Olympics.
Oh yes,
Without
they do
upgrading the
need to do
transport,
that.
it's,
Yeah,
I
I
mean,
just don't know
Sydney
if they're going to have.
upgraded the, transport out to, what was Olympic Park at the time, which is now a big
Yeah.
residential area in Sydney. And that upgrade to the transport through that system was probably something that the current residents in that area appreciate.
Well,
Look,
at least, yeah. Can I just say something about the transport? One thing that they'll probably have to do is they'll probably have to buy back the concession for the Airtrain. So one of the big problems they've got is that you've got this private operator that owns the rights to the Airtrain, and they're making a significant amount of money off of that. That's a bit of a cash cow for them because they've got that monopoly. Well, I mean they've got competition with Uber, of course, but they actually do. I think they're doing very well out of that, and the government's going to have to buy that back so it can have reasonably cost-effective transport from the airport to Brisbane City during the time of the Olympics. So that's going to be an additional cost burden to the government associated with this Olympics. Because otherwise, how's it going to work? I mean, I think they need the train, that air train, as part of the transport solution for the Olympics.
Yeah, to be honest, I haven't actually looked at any of the details of what they're going to be doing the infrastructure spending on for the Olympics. I'm just creating a theoretical case for what one might say were they to be more generous than I am about such things normally. And a lot of it will
Well,
come down to the competence of our planners. And as you would
yeah,
know, I have no inherent faith in the competence of our planners, but hey, maybe they'll surprise us.
righto. Now, the misallocation of investment, that's one economic failure. Another economic failure that I'll cover now is ignoring how people respond to incentives. And in Australia at the moment, arguably, there's no better illustration of this than the National Disability Insurance Scheme, the NDIS. It's proven very difficult to contain the costs of this program. At times, it's been growing at 20% year on year. It's a very expensive program. It's an uncapped, demand driven entitlement program. Now, this is not to deny that the scheme has done good things for people with disabilities, that it has been life changing to many people with disabilities. We obviously need to look after the people with disabilities. It's the there but for the grace of God go I argument. It's a Rawlsian argument, thinking about, well, what type of society would we want if we didn't know where we'd end up in life? So you can see the arguments for the NDIS. The problem is, as it's currently designed, and the incentives are such that it's going to lead to more people getting on the NDIS than is optimal, and it's going to lead to cost blowouts. And it's not just rorting, it's a problem with the design of the scheme itself. Even with zero rorts, it would still be unaffordable. So let's listen to my chat with John about the NDIS. One of the big problems is this: it's all entitlements, so it's hard to manage or control the growth of entitlements, isn't it? They'll create an entitlement by law, and it's very difficult for them to predict what they'll end up spending on it. NDIS, for example, I mean, they create this system. They'll think, like, if everyone behaved in a way that you only are treating or giving money to people who generally need it, or you're helping them out, then maybe you can contain the cost. But as soon as you create any government program like this, you're going to have people find ways to get access to that pot of money, and then the demand on it, the needs, or they just keep growing. We want to, you know, help everyone or provide this really high level of service, and it just becomes very difficult to control the costs. And I think that's partly why people are frustrated, because they see people know the NDIS is being rorted. We see all the videos, we see the reports of it. We probably know people we suspect are rorting the NDIS, and that's part of the dissatisfaction that we're experiencing in Australia at the moment.
Yeah, when the NDIS topic comes up, I always make this point. I'm going to make it again. There are people rorting it, no doubt. There's a bigger problem, and that is if you got rid of all the rorts, it would still be unaffordable. And
Yes.
so I worry sometimes when we put the conversation in the term of rorts, because that's politically the best way of doing it, because everyone's annoyed at the rorts. But if what you do is you get political buy-in to cracking down on the rorts, once you've done that, you've got no political buy-in for the next step. People need to be aware that NDIS was structurally and fundamentally a dumb idea. Now, not the idea of helping people with disabilities, but
Yes.
the idea that you would tell parents, if you can find someone who says that little Johnny has ADHD or is on the spectrum, then we will give you thousands of dollars in a free trip to Europe. You've got to factor in that a bunch of parents are suddenly going to discover that little Johnny has ADHD or autism. Behavioral responses are real. That's
Yeah.
the big insight that economists have that non-economists don't get, that we have to keep repeating ad nauseum. Behavioral responses are real. People adjust to incentives. And as you say, when they looked at NDIS, they looked at the current number of people with problems and thought, well, we could fix that by offering them money,
Yeah.
not factoring in that the offer of money will change how many people self-identify as having those problems.
Yeah.
And there is no area of life where people don't respond to incentives. And yet it seems to be tricky to get politicians to understand that. As the great economist Thomas Sowell said, that the first law of economics is that scarcity exists and decisions must be made between competing priorities. The first law of politics is to ignore economics. And we have that here with the role of incentives. Politicians constantly ignoring the role of incentives. So NDIS is got problems with rorts, but it's also got problems with incentives. And unless you address the second part of that as well, it is not going to become a sustainable government program. Uh,
Yeah. Okay, so we've come to the end of the episode. So that's where we'll leave it. We've had four conversations on different issues, but one underlying theme. Living standards, they don't rise by accident. They rise because the incentives, they reward saving, investment, and risk-taking. They reward taking chances, innovating, designing new products, investing capital to become more productive. But living standards stall when we tax capital income more, when we disincentivize that investment. They also stall when we misallocate public money and when we design government programs without thinking about how people will respond. Because if we have to pay more and more in entitlement programs, we need to have higher taxes, and those higher taxes stifle work effort, they stifle investment, and they stifle innovation. So that's why I agree with John that what the government is proposing with the capital gains tax reforms is bad policy. This is not the time, in a time of a productivity slump, it's not the time to be taxing investment, to be taxing risk-taking at a higher rate. That is only going to discourage the investment that we need to boost productivity. Thank you.